Okay, everybody, good morning. Happy Friday. Hour late start. Started early yesterday, started late today. Was getting a chart together that I think will be helpful on where the money supply has been, where it's going, and also why Bitcoin is uh, highly likely to be a valuable hedge against increases in the money supply. But I figured I would do this also through the lens of some of the ideas of where and why the money supply grows. I'm not going to name names. You can easily find this stuff uh, on Twitter or wherever. But there are hardcore people in the libertarian right that seem to think, for example, people like Javier Milei is failing as a libertarian or a free market or a private property appreciating president of Argentina because he hasn't shut down the central bank and rebuffed the IMF. There's a there's a video you can find online of Murray Rothbard at the end of the 80s, the start of the 90s. There were a lot of Eastern European economists, some Lithuanians in particular, that were going through the U.S. Sort of academic establishment trying to understand the best way to structure their financial system. And you can find this clip of Rothbard online saying that the Lithuanians, they're not going to have a central bank and it's going to be great. Of course, that ended up not happening. Every nation in the West already had a central bank, and so it was only logical that the Lithuanians and all other Eastern European countries would continue with that model. When I say these things, I'm not defending everything about the model or the use of force to run amok with a nation's currency supply. But the underlying nature of currency deposits, the money supply, is something that has grown whether there is a central bank involved or not. It's a very key point. And so, again, I think a lot of the times our conclusions could be similar. So some of these people who, for whatever reason, are bashing Javier Milei and saying that he's not a free market guy, even though clearly he is, and he should have shut down the central bank. There would be tremendous pain if he would do that. And it's something where even Ron Paul, who I think most Austrian free market people respect, has always said that there should be, if we're going to transition out of the centralized fiat monopoly, there should always be indeed a transition period. Ron Paul's never argued for taking pensioners in the United States their Social Security contributions, even though everybody knows that that's essentially a Ponzi. It's a system where the young pays for the old, and if you want to get out of it, you can always argue for ripping the Band-Aid off to get it over quick. You can certainly argue for those points, but the cascading effects are really, really deep. And so this frames my Bitcoin view as well. So I just want to show you why it frames that, because it runs really, really deep throughout the economy. But again, the crucial point here is, though I certainly agree that the central bank causes distortion, causes all the bad effects of fiat inflation, we still had money supplies that grew in societies without a central bank. Okay, so there's something more going on there than just saying, close down the central bank. Anyway, with that disclaimer, I want to build out a money supply. Morning, Fred. Can't sleep? Yeah, I was just talking about old Javier Milei. I'm definitely a fan, but it's interesting that the purists, some certain people, are talking down to him these days. So anyway, I just want to build out a money supply to show you, regardless of the administration, regardless of the time period, it's always going to grow, and certainly it's been growing more chaotically in the last 15 years than not. So anyway, we're starting with M0. Okay, so M0, and by the way, everything I'm going to show you on the axis here that's going to come up is part of the money supply, and it's a liability of the banking system in some way, except for this one. This one, which is called M0, is literally that physical cash you put in wallets and grocery store tills. This is the liability of the Fed. And this is the only part of the monetary base that we can actually own, that we can hold. Okay. All right, so you see it was less than $1 trillion before the global financial crisis, grew at a very fast clip after the GFC, and then pandemic hits and it grows very, very fast before leveling off. Coincidentally, you might see this number about 2.3 trillion. It's about the size of Bitcoin's market cap. It's not the total currency issued because there's also a little bit of cash, like 150 billion or something, in bank vaults around the U.S. and outside the U.S. That's also part of the monetary base. So if you count that as the total physical currency stock, Bitcoin at its 2.3 trillion is just a little bit smaller than that. But this is the only physical currency supply that Bitcoin has not passed. The yen, the euro, the yuan, Brazilian real, Swiss franc, sterling. Bitcoin is bigger than all of them individually. Okay, so this is M0. Now let's just build it out. Let's put on demand deposits. Big bump here from pandemic times. We were at 3.2, 3.3 trillion in demand deposits. Now we're at like 7.5. Okay. I know it says M1 in the tooltip for demand deposits, but if you add up demand deposits and this M0, that is M1. That is the value of M1. So it's about $10 trillion at the moment. There is an asterisk here because the Federal Reserve stopped publishing, like the smart technocrats that they are. They stopped publishing M1 in April of 2020. Completely asinine, doesn't help anybody. So you have to back into it with the data that they have. They still publish demand deposit data, so I'm simply adding it. But it's not precise. The actual M1 aggregate will count if certain banks owe other banks. Like usually there's a double counting of demand deposits, and that's actually included in here. So they would net out that double counting as part of the M1 money supply. Whatever. It's not a big deal. Well, it's kind of a big deal, and it's annoying that they don't do it anymore. But so I have to kind of recreate approximately the M1 money aggregate. As well, they stopped publishing M3 in 2006, which I'll talk about in a second. All right, so here we go. This is M1. This is M1. You add these two money supplies together, M0 plus M1. They're all liabilities. M0 is a liability that's a cash outside of banks. That's a liability of the Fed. Demand deposits, that's a liability of banks, the banking system. I'm going to come back to demand deposits because everybody, especially in this hardcore side of the Austrian school, I consider myself an Austrian as well, but maybe a more realist one. There's a lot of drama around this money supply, but once we build out the rest of the money supply, you'll see it's actually less drama than perhaps should be made of it. All right, so this is M1. Now we're going into the M2 monetary aggregate. Okay, what's the first thing? It's the biggest actual money supply that there is. This is savings deposits. All right, this is part of M2. Savings deposits. It's where most people hold their money. See, it was about $3.5 trillion pre-GFC. Now it peaked at around 11.5. April 2022. Now it's down to $8.7 trillion. All right, another part of M2, not a big part, but it is a part of it, is retail type time deposits. Okay, technically, the United States says that this is a smallish time deposit, like under 100K in value. Other countries just call it retail. I'm calling it retail. Okay, so it's a pretty small amount. See, larger pre-GFC, not very large right now. And also, by the way, if you look at M1 money supplies from this April 2020 date versus M2, they're nearly the same. Again, the Federal Reserve in their infinite wisdom does not choose to make backward compatible money supplies. So they have this weird gross account now called like total liquid deposits, which is demand deposits, savings deposits. It's completely asinine because they said that the rules changed and basically a savings deposit is exactly the same as demand deposit. I mean, the United States invented these money supplies and now they're changing them. No other country is doing it. So anyway, I'm trying to make a backwards compatible one for you. All right, so a little part of M2 here, and here's the rest of M2. It's called retail money market funds. All right, what's a money market fund? It's basically like a stable coin. Stable coins are, as we know, the issuer issues the token. You do whatever you want. You trade with it. You give the issuer money. Eventually, you might give the exchange money. The exchange gives the issuer the money. And then with that money, the issuer buys treasuries and takes the spread, and it's a sweet deal. One of the best businesses ever. Money market funds have been around for a long time, since the 70s. Here is the retail component of it. This is not a government guaranteed deposit, but basically it's, you can use this money to invest in stocks. It's an easier way to invest in stocks, basically. All right, retail money market funds, still around $1 trillion now. Sorry, $2 trillion, but around $1 trillion in the past. Not that big. All right, and with these money supplies that I just showed you, we got to total M2. This is total M2, right? And that more or less has not changed as a calculation. Again, look at this demand deposits. It's so stupid. They don't really calculate this anymore from April. So you just see from here, the numbers shoot up according to the Fed, and like M1 would be somewhere here. It's insane. But anyway, this is how it more or less the money supply looks, if you counted everything the way it should be. All right, the biggest, as you can see still, is savings deposits at $8.7 trillion, roughly. All right, now we're going to move into M3. As I said, the Federal Reserve has not published M3 since February 2006, but they still do, in a very roundabout way, publish the data, some of it only quarterly. So, and by the way, it's so slow to update. This is why I'm still stopping this in March of this year, because even though it's August, they haven't even published the second quarter's data. So it makes this a very lagging indicator. It's very annoying, but this is what they do. All right, so now, just like we had retail, that's savings, retail time deposits right there, right? We also have institutional time deposits, much bigger. It's part of M3, okay? $2.3 trillion, number 5 there on the money supply. This is part of the M3 money supply. It's not published anymore by the Fed in totality, but they do publish these components. Next thing, institutional money market funds. Same thing like a stable coin, but money market funds have been around a long time. It's the cash that you get when you sell a stock in your brokerage account. It's not a bank, by the way. It's you call it the banking system or the financial system, but usually these are brokerages or sister companies of banks. These are not regulated banks usually that issue money market funds. All right, and then the last one, which is really not the last one, I'll explain, but it's the last one that I have data so far, is repos. Repos are, again, an institutional instrument. It's basically treasury funds, treasury securities, I should say, trading around like cash. It's levered up treasury securities. It's called a repurchase agreement. And there it is. And it's at the moment about $6.8 trillion. And this is not Federal Reserve repos. I'm going to show those later. This is repos of institutions, hedge funds, money market funds as well, can be on the other side of this. But this is liabilities from institutions that basically trade treasuries around like cash. This is almost the total money supply. It's about 37 trillion. Like I said, the Federal Reserve does not publish these three anymore. It's asinine that they don't. In totality, they don't publish M3. They haven't since 2006. There's one more component that used to be a part of this money supply, but now it's almost impossible to calculate. Not impossible, but it's going to take me a long time to get the data. And that is Eurodollars. Eurodollars are also part of M3. That is basically offshore dollars or dollar-based accounts outside the control of the Federal Reserve. So in Credit Suisse in Switzerland or UBS, Credit Suisse is a bad example, UBS, Lloyd's of London, dollar-denominated accounts outside of the purview of the Federal Reserve. No one knows how big that supply is at the moment. Last time the Fed calculated it, it was something like $1 trillion, I think a little bit less if memory serves, here, already in 2006. This was pretty big in 2006. And that was probably still undercounted. The only way that I can tell to really get this is go through all the foreign currency deposits that other central banks publish, which I haven't done yet. And then you would assume that the dollar is roughly 60% of that, because that's the foreign currency, including when they say foreign currency reserves, it means like treasuries that other central banks hold. You use that ratio roughly, that would give you euro dollars. Anyway, it's a huge number. I don't have it. But what I do have is everything but the euro dollar. And if you count that, this is how the money supply looks. Good evening, Tim. Good evening. So basically, as I said just now, it's impossible to calculate it without going to other central banks, looking at their reports over time, which is difficult because there's no like APIs for this stuff. And then you got to look at the foreign currency. So like the M3 money supply of the UK does not include euro dollars. It's only sterling-based money. Okay, not base money, but based sterling denominated money. So you count up all of that, but then they usually have a foreign currency section, sometimes broken out, usually not. You'd have to count that up. It's usually going to be denominated in whatever, sterling, for example. Transfer that to dollars, do the conversion rate, and then assume a ratio, probably 60%, something like that. Of course, you could be fancy with it and take the foreign currency reserve of central bank ratios over time, which like the dollar, something like 60%. That'd be the best way to do it. But no one knows for sure. No one knows euro dollars. So anyway, the point is there should be a number 8 here, which is the last component of the U.S. money supply, which is euro dollars. It's not known. It could be huge. It could be at least 10 trillion, could be 20. I don't know. But if you forget euro dollars for the moment, look at this backwards compatible money supply. This is how it looks. All right. Now, I want to say something again to our Austrian friends, or at least to the more radical view of the Austrian school that doesn't like Javier Milei. A lot of drama has usually been made about the demand deposit, the sacred demand deposit over the years. And it is huge now, by the way. Okay, here it is, number 1. It's huge after all the cash subsidies of the pandemic. It's very big. This is business and personal, by the way. Everybody has a checking account, demand deposit account. But look at it before the GFC. Let's look right here. Let's zoom in. Number 1 is the sacred demand deposit total. Do you think demand deposits caused the GFC? Do you think this unbacked fractional reserve, scary account, which was government guaranteed, do you think that that caused the GFC? And the answer is it did not at all. It was at an all-time low relative to the total money supply. I could put the ratio up. I've done it before. I'm not doing it on this chart. You can clearly see the hot money, the red money, the institutional money was way more prominent before the GFC. And it's absolutely what caused the GFC. It's still, I'm still willing to grant that it was government intervention that did this. There was something, it was called Regulation Q, I believe. And that started all the way even in the 80s. And that was basically like banks were starved. Actually, not banks, but depositors were starved for yield, just leaving it in the demand deposit account. So banks went to please them. And they said, well, let's let investors put more money in different types of accounts. And that's exactly what they did. And so you had this sort of moving up the risk curve in the 80s and the 90s into accounts that were not demand deposits. So it's still government-led distortion, but it's not the idea. There's this idea that the demand deposit is some sacred account. It's not. It's just another account. Yes, it is the lowest account in the monetary stack. Not the most liquid, one of the most liquid, but you can see savings the accounts is still bigger. By liquid, I mean sort of bigger pool of money. And this is how it looks. This is the total monetary supply. Usually when I show this, I break it up to M1, M2, M3. I think it's actually more helpful to show you the components. These are the components. The demand deposits were not a part of the global financial crisis. It was not at all the reason that the global financial crisis occurred. All those mortgage-backed securities, the trading of crazy leverage ratios, that was all done with that red money, institutional crazy money. Again, I'm not letting the government off the hook. I'm just showing you that there are holes to poke in theory that this is all sort of, I don't know, a conspiracy of demand deposits. Maybe the next one will be, by the way. You see demand deposits are huge. But here's another thing to say about M3 money. Look at the, well, I'll hold off on that actually because it has to do with Fed repos. But you see roughly with our eyes, especially the repo section, all right, which is basically treasury securities trading very hot, being levered up. That was very big right before the GFC, okay, and it even cooled down the months before. I think my indicator is October 2008, so it was very, very big before the GFC. What does it look like right now relative to the rest of the money supply? It's getting hot again. I have no idea where the top could be, if there is a top, but it's getting hot. No doubt about it. All right, so this is, again, to be clear, these are liabilities of banks, brokerages, the financial system, all liabilities except for this M0, which is cash outside of banks, outside of bank vaults, which is a very small number. But this 2.2 trillion, which is sitting in vaults and, personal vaults and wallets and grocery store tills, this is the only liability that's from the Federal Reserve, from the central bank. Okay, so again, this Fed distorts a lot, but is the Fed the financial system? I would argue no. This is $37 trillion worth of liabilities. 2.3 are from the Federal Reserve. Okay, now let's put the bank money or the base money in this so you can see how the Fed has gotten more involved over the years, which again is not good, but actually wasn't involved pre-GFC. Okay, so this is a negative number because in this case, this money is an asset. It's still a liability for the Fed, but it's an asset for the banking system. All right, so this is what you call the bank reserve account, plus that vault cash, which is very small. I'm just putting it in one line. It's immaterial, frankly. This is what's basically in the vaults of banks. So let's go again to the pre-GFC number. $100 billion. All right, pre-GFC, we're at 15 trillion in monetary liabilities, total system of the United States. The Federal Reserve had only 100 billion sitting out in the system, sitting out as bank reserves. So it's very small. Don't get me wrong, the Federal Reserve causes distortions. There were implicit guarantees. These mortgage-backed securities were going to be safe. They were government guaranteed, all these things. But as far as the actual money supply, we couldn't see the global financial crisis happening just looking at this chart on the base money side. Base money side, again, is that negative number, that negative 100 billion. It's only 100 billion in assets that banks had. You do see the money supply stretching out on the broad money side. That is the M3 money side. It's huge at this point. 4.3 trillion in repos, 2.4 trillion in money market funds, institutional time deposits, 2 trillion. It's really growing fast. And it broke. And then Ben Bernanke, in his infinite wisdom, decided to just take all of those bad liabilities from the top end of the curve and guarantee them and bail out all the sister banks on the bottom end of the curve. So all these banks now were flush with these reserves, and it just doesn't make any sense. Normal banking doesn't even make any sense right now. The Federal Reserve is has way distorted the money supply. And they tried to get back down to a more stable level right here, right before the pandemic. You see that? Again, just trying to be precise. All Bitcoiners were saying all the Federal Reserve does is print money. Let me take everything off just so you can see the detail here. Okay, this is the monetary base. M0 plus bank reserves. Here you can see QE 1, 2, 3 right there. But look, they were trying to destroy money from here. Every time this goes down or closer to zero, in this case. Yeah, I know it's kind of confusing that one's a positive, one's a negative, but we can only hold this M0. Only banks can hold this line. That's why I'm doing it this way. So from 2014, summer, until September 2019, the repo crisis, the Federal Reserve was destroying digital money. They were actually shrinking it, but they still distorted everything. You know, there's Fannie, Freddie, there's still huge debt on their balance sheets, by the way. But anyway, they were trying to normalize. Of course, they don't know the real level. Central banks never can. And even before the crazy days of the pandemic, it was right here, basically from September to February, they were increasing the balance sheet again. That is, this number is getting further negative. And then all hell broke loose. So it's a combination of factors that made things crazy. I'm not explaining away what they do. I'm not saying that they're blameless, but this is the monetary base of the United States. Now, we can add one more item here. And this is, like I said, remember the repo facilities for banks. Basically, it's banks trading treasuries like cash around the financial system. It's a huge number. All right, I'll put them here now. I'm putting the repo facility on bank side here. And let me I'll leave base money for a second. So base money, again, is zero in this vault. Here's the repo facility that private banks hold. And here's the repo facility that the Fed was offering during the depths of the financial crisis. You add that on, it's here. So it got up to about 2.5 trillion. See that? I'm looking at the bank icon in the tooltip, the Fed repos. This really should be like, think of it as a Federal Reserve icon. But this is basically base money for non-banks that the Federal Reserve was offering. So brokerages, hedge funds, even money market funds took advantage of this. And this was a huge amount of liquidity that was actually removed from the system. Okay, so they parked, just like bank reserves took away liquidity from the system. It took away loanable funds from the system. All this, especially because they're paying interest on those reserves. This is a whole other topic, but it's related. They started to pay non-banks repo money, which is basically a levered up treasury security. That's all it is. The Federal Reserve has a bunch of treasury securities on its asset side, and as a liability, it pays non-banks. So the green line, or the sort of this vault line, is bank money. Non-bank money includes this line. Okay, so there you can see how it goes. Now, again, this is only to March, unfortunately, because I'm still waiting on all the Q2 data. But what is happening? Look at number 7 from June of 2022, roughly, until now. What's happening to number 7? This liquidity is leaving the Federal Reserve's balance sheet. See? It's leaving the Federal Reserve's balance sheet and is going back into the system. This is a huge pool of cash. All right? It's just gone up. Look at number 7. 3.6 trillion now is 6.8 trillion in the non-bank shadow money repurchase agreement section. It's a huge pile of money. So this is, again, huge money that could flow into Bitcoin. Hello, Turkey. Absolutely. So, by the way, repos / money market funds. I'll put institutional money market funds here now. This is basically stablecoin liquid money. Stablecoins will attack these money supplies for sure. Whether they can take this volume and increase it, I think they can. All of it is more money that has a possibility to, for sure, buy treasuries. But also, when they get scared, that money can go back into Bitcoin. So, just gasoline on the fire type money. Let me just show you again really quick so you can see. Let me take off this. No, just looking at, this is the repo market in its entirety. I bet you've never seen this chart before, right? The Federal Reserve wasn't even publishing this, by the way, back then. Because of Dodd-Frank, they had to republish the numbers. It's very hard to add all this stuff up. It's annoying, but if you can find, there's an exhibit specifically for repurchase agreements now that the Federal Reserve publishes. So you see it was way overextended before the GFC, then collapsed, and then sort of went sideways. And then once the COVID madness started, they saw this growing. They didn't want it to grow. They didn't want this inflation in the system. So they said, park your repurchase agreement value with us, dear money market fund or hedge fund. We're going to make a huge facility for you. They did. They kept this very low. The fact that this is low in the market, but huge in the Federal Reserve's balance sheet, means that there's less money multiplying. They did not want this situation, basically, to repeat. See here, look, there's no Federal Reserve's doing nothing pre-GFC. This is a huge part of the global financial crisis. Is all this mortgage-backed securities and stuff that was wrapped up in these repos. This is a huge part of the GFC, and this is $4 trillion already in 2007. So it got to, again, $4.5 trillion, and they said, nope, we don't want this to be the case. Let's take this liquidity out of the system. So they did. But now, as usual, they know that they can't do it for too long. They distort the markets, so they're trying to let the liquidity go back into the system, and you can see it goes right back into the system. But now it's dangerous. It's dangerous. I mean, it is high. Again, I have no idea what the right level is. I'm just showing you. This is how it looks. So this is the repo sort of components of the money supply, and the Fed is now much less involved in the repo market than it used to be. And again, when you hear repo markets, if it's confusing, just think of it as a levered up treasury security that trades around like cash. It's an institutional type instrument. It's like if you put on, some shitcoin into an exchange and say, I want to lever this up and trade Bitcoin on BitMEX, whatever. I don't even know BitMEX, what shitcoins they allow, but you do this on any exchange. That's what hedge funds, institutions, non-banking institutions are doing with treasuries, with repurchase agreements. It's all that it is. Okay, so it's back in the system. This liquidity is now back in the system. It's huge. And this is only Q1. So if you put it all back together, put these bank reserves back. Well, let me take off, just to again reiterate. This is the monetary base. This is the monetary base. So you add up the 2.2 trillion plus the three and a half, it's like 5.7, 5.8 trillion is the monetary base of the US right now. Bitcoin is not as big as this, but this is the Bitcoin comparable money supply. And probably just like the Federal Reserve, we're going to have Bitcoin that's sort of sticking around in governments and institutions, and Bitcoin that other people are using. This is not a layered solution, by the way. This is just base money Bitcoin. UTXOs are comparable to this chart. This is base money Bitcoin, what you're looking at right here. Thank you, Fred. You're always very, very kind. I appreciate it. Really do. So this is base money Bitcoin. And then if you want to look at the layered solutions of the United States money supply, it's demand deposits, savings deposits, retail time deposits, retail money market funds, institutional time deposits, institutional money market funds, repurchase agreements. It's a big stack of money. Back to my little preamble notes. There's no way this is like going to zero. This is why I'm an inflationist. I'm not a deflationist. Like people say this is just, it's all going to collapse, go to zero. No, they can absolutely keep this going for a long time. It's good for Bitcoin. Maybe not necessarily good for, the average worker, but this is how it looks. And then you add Fed repos, so extends it a little bit, but these big negatives, all right, which you see, look at the last level of the tooltip, 2.7 trillion here. This was right about after the peak of QE3. It was actually 2014 right there. 2.7 trillion. All right. On the negative, that means central bank money for banks that we couldn't hold. This is very distortive. And it's also just not normal banking anymore. Here, look, it was like reserves were, as George Selgin says, reserves were a hot potato. No one wanted to hold reserves because it didn't yield any money. But the Fed started paying interest on this, which was also an insane thing to do. So they bailed everybody out. They bailed out this top end of the stack, put the reserves with their banks and sister companies and everything. And then they said, don't lend this out because we don't want inflation, of the price variety, price inflation. So we're going to pay you interest on the reserves. And that's what they've done for the past 15 years. And then, of course, another crisis hits, and now they've put the money into the system itself. That's why we saw a lot of inflation. Price inflation hit the system this time. Less hit the system this time, but still hit. And, they just keep the party going. So this is kind of the broad money corollary to the chart I showed yesterday, which I'm going to show again. And this is why Bitcoin has just got a long way to go. I mean, it's going to happen. Whoops. Sorry, I got to reset this. Go back here. You're welcome, Turkey. Thank you so much for watching. So, again, this is not going to zero. It's nothing to like. How many newsletters have you guys read over the years? I've read a lot, which say, from here, I started to go down the rabbit hole right here. And how many newsletters said it's all collapsing, gold's going to 50,000? They can kick the can down the road a lot. And this looks insane. But, they've learned from here. They've learned how to kick the can down more. That's why, they add all this base money to banks to hold and all the rest. But they can keep, that's why I keep saying skate to where the puck is going with Bitcoin. The money supply is going to continue to increase. Okay, so here I wanted to show, let's take that off. I showed this yesterday. All right. The Federal Reserve with bank reserves does $1.1 quadrillion a year. Bitcoin does 7 trillion. So that's less than 1% of what the Federal Reserve does. Yes, it is. Yes, it is, and yes, they have. So this is another reason why I'm not a fan of like the hyper Bitcoinization sort of uh, row, because look, the dollar's network effect is still enormous. And I'm going to show you, these are flow numbers. All right. I talked about this yesterday. These are flow numbers. But where does this money fit on this chart? Who can tell me? Who can tell me? This FedWire money, this $1.1 quadrillion in flows, which part of the money supply is it included? The answer is not one of these. It's only here. And there's a little bit of alt cash here, but it's inconsequential. Even before the global financial crisis, when there was only 100 billion in bank reserves, right? Zoom in, you see how it looked. 100 billion in bank reserves. Even before the GFC, they were still doing 700 trillion a year. That's 700 trillion. You get the velocity. You take 700 trillion divided by 100 billion. So it's an enormous velocity that the dollar has. It's an enormous dominance. Now, Bitcoin's doing great. It's catching up, but it's still got a long way to go. 157 times smaller at the moment. And you can see how much smaller it is. This is the comparable money supply with Bitcoin. This money supply. Plus our cash outside of banks. Physical cash is also a part of it. But add these two numbers together. I know one's a negative. It's weird, but it's money for banks, not for us. Okay. All of these other money supplies, these layered solutions, this is, your Coinbase account, your Kraken account, futures, open interest, other derivatives. It's also why I think Bitcoin banks are coming. I'm not defending that idea. I don't think it's a pure way to do it, but Bitcoin banks will be, exchanges will turn into Bitcoin banks eventually. Hello, David. Not while the Federal Reserve is in charge. I'd say no. Once Bitcoin is a part of it, I think, and like really becomes the base money, then it will be better. Especially if it's not controlled, especially if it stays decentralized. But if it becomes more controlled, then I'm less optimistic. I think price-wise, it will do just as good as anything. But yeah, for sure, the Federal Reserve and any central bank will exacerbate these crises, and as long as they're around, there will be crises. But the good thing is, and this is where my conclusion for sure agrees with any hardliner Austrian or someone that doesn't like Javier Milei for some reason, for sure Bitcoin is going to be a solution here. The primary solution. So we can all be thankful for that. But this is not stopping. There's no way this stops. There's no way this just goes to zero. I had a chart with the velocity somewhere, but I can't find it at the moment. Again, I got to restart these charts all the time. But this smooth number here, I'll show you exactly. This Federal Reserve FedWire base money flow value, which is now $1.1 quadrillion, $1,100 trillion a year. It actually moves a lot. Bitcoin has no technical constraint to reach this. It's just going to take time. Right? Here's where Bitcoin is right now. You can barely see it. All that Bitcoin needs to do technically, it's not even technically, all the Bitcoin needs to do is have the price rise, and Bitcoin can eat into this value. But it's not going to happen overnight. It's just not going to happen. You know, they have the guns, they have the military, they have the so many monopolies. Oops. But it will. I think it will eventually eat into it. And this, to explain again, this is the flow over 12 months of just really this money supply here. So it's a huge velocity. And there's a bank's, this is what you call real-time gross settlement. I actually wanted to show you guys this. Good morning, Ansi. Good to see you. Great meeting you in Finland. Ansi took us out for dinner. It was great. Probably. I don't know. What do you think, Fred, if you're still on here? They've already got a stable coin, basically, so MSTR is probably going to become some systemic, huge Bitcoin institution. Whether it's trading substitutes, you know, like their preferreds, or they start offering, you know, in-kind payments in Bitcoin. It's all going to take some time. Just want to show you guys again so you see how big these markets are and why you can't just close the central bank. This is another point I want to say at the beginning. Again, I'm not defending their craziness, but you can't just... All right, so here's Wikipedia. This is called real-time gross settlement. Yes, Fred answered. I agree. The Goldman of Bitcoin. Makes perfect sense. So this is what the central bank does. It's actually the only institution that does this. All right, they're funds transfer systems where the transfer of money or securities takes place from one bank to any other bank on a real-time and a gross basis to avoid settlement risk. This is what the central bank does. It is the ultimate transfer of money. It's not a loan. You can actually... banks do lend Fed funds to each other. That's the Fed funds rate, but that's not what real-time gross settlement is. Real-time gross settlement is when they want to settle a loan or settle a payment, they move the money from their bank to another. That's called FedWire. That's this system. It's an enormous system. It's absolutely enormous. And here we can see RTGS from different countries. Okay. All right. The only one I know for sure is called CHIPS. It's the UK's. Let's see if I can find it. Oh, CHAPS. I couldn't even get it. CHAPS. Clearing House Automated Payment System. That's the United Kingdom. There you see FedWire. The United States. So there's all these systems. You know, Swiss call it the Swiss Interbank Clearing. Bitcoin is going to compete with all of these systems. This is Bitcoin's native competitors. China's is called CIPS, cross-border interbank payment. So anyway, I've just shown you one, which is the FedWire, which is the biggest one for sure. But you have all the other ones. You have this CHAPS. You have all the sterling payments between banks. It's enormous. And so you see just where Bitcoin is, where we are. It's absolutely enormous. You can't just close the central bank. I mean, this is why people that say like this give Millet such a hard time. It's just, you would cause so much pain and misery. And then what would you replace it with? I mean, Bitcoin? Great. Okay, great. Millet doesn't even understand Bitcoin. As we know, he started with I think he pioneered with some shitcoin project. I'm not defending the system. I'm just defending sort of major changes. That's why even Ron Paul says he's not in favor of abolishing Social Security overnight because it would be too destructive. But the good thing is Bitcoin will clearly accrete into all of these systems, no doubt. I mean, the party's already on. Everybody knows. Fred, what's the likelihood of interest rates being lowered next month? I mean, it's like 100% probably that there's going to be a rate cut. Like, it's more gasoline on the fire is coming. The party is going to keep coming for Bitcoin, but I'm just trying to show you the scale of like everything here. So again, Bitcoin is comparable to this line, only this line, and then this M0. Add those two together, 5.7, 5.8 trillion. Today, only banks can use the line. That's why it's negative on my chart. But all of us and institutions, retail, whatever, we can use all this other money, which is 37 trillion. It doesn't include euro dollars, which is probably another at least 10 trillion. So the party's going to keep going. There's just no way. You know, think about how painful the GFC was. This was a drop from, actually, I don't have the totals on here, do I? But I'll tell you in a second. The reason why they keep increasing the money supply is to stop the pain. Nobody wants to take the pain. They're not going to stop doing that. Again, I'm not defending it. I'm just saying that's what they're going to do. Oh, interesting, David. Thank you. So we'll have to wait till I get the third quarter numbers, and then we can look back and see it. That's the only problem with this chart is it's so slow to update. You know, I wanted to show you guys Q2 in here, but I can't even do it because I don't have the numbers. But yeah. Well, if it's not September, you know, then November. But yeah. Also, if you think about other political issues like what is it, UBI, other things, I mean, it's obviously just more fuel to the fire for Bitcoin. But I do continue to think we should focus on the base with Bitcoin. So again, it's much smaller than the total. Total's 37 trillion. The base is only 5.7 trillion, right? Which again is the zero, which is cash, plus this vault, which is bank reserves. 5.8 trillion at the moment. Actually, not at the moment. It's coming. I don't know. This was March, so I think it has come down to about 5.7, 5.6. It's going to go up soon. It's coming down, obviously, because they're keeping interest rates high. And so the Federal Reserve is not buying treasuries. So the monetary base typically, not always, moves in the opposite direction of interest rates. Let me tell you the change in the money supply from from 2008. So the top here was somewhere right there, March 08. So in March 08, sorry, I'm doing this manually, but I always forget some things I'm going to present. It was 16.5 trillion. 16.5 trillion, and then probably the nadir was somewhere here. Let's call it June 2010. Sorry, 15.4. That's only 7%, 6, 7%, 7%, let's call it. So think about all the pain that the world went through when the United States money supply fell on a broad basis from 16.5 to 15.4 trillion. That was like the end of the world, right? That's a 7% drop in the money supply. Of course, nobody knew it at the time. The Fed wasn't even publishing these repos. It's all a mess. And now you see the growth here. Plus, the Federal Reserve is not involved anymore in the repo market. Not really. There's only still 600 billion it's holding in repos, which means that's out of the system. It's liquid money for, it's safe liquid money, but it's not liquid money that's sort of deployed to risky projects. It's just owning treasuries via the Federal Reserve for non-banks. It's a way to say that. But that number 7 is really going high. And 6 as well. So I would submit to you that they're not going to let the money supply fall. They're just going to keep printing. They're just going to keep helping the risk takers. Good morning, Randall. Yes. Perfect analogy. It's definitely gobbling up it, but it's going to keep getting bigger. So it's bigger pieces to gobble up. Okay, I think that's all I wanted to show with that. Let me show you. The top 10 percentiles just again. Nice. I haven't heard details about that, honestly, but that, of course, is great. You know, again, I mean, if you look at the range of characters that run countries today, like Millet is absolutely someone on the freedom side. Is he perfect? No. But Argentina's system is as flawed as it is, and as much as IMF debt as they have, still works like this. They need to make payments. The central bank is the ultimate real-time gross settler. We'll see. Another reason, again, I know this is kind of echoing yesterday, but, you know, plenty of time. I think these are still very good indicators. The top 90th percentiles, that means 90th to the 100th. We're never going to hit this number. All right, by the way, that happened only sort of twice, once here in 2011 and once in 2013, which is 7.8 times the power trend. So if we assume the 4-year top ends in December, which again is a very caveman-like assumption, I don't have anything scientific to point to it. The power trend is 125K at the end of the year. Would be at 1 million if we hit the 100th percentile. It's not going to happen, in my view. I mean, again, I would be more than happy to be wrong on that. But you see how far away the 100th percentile is from the 99th? Okay. 2017 was an enormous top, by the way. I mean, we were above the 99th percentile in price for a couple weeks, like 2 weeks. Did not hit the 99th percentile in 2021, and indeed did not hit the 99th, 98th, or 97th. But we're very close, and we did hit the 96th. Again, this is confusing. We had a double top. I saw something from Plan C, which I agree with. It could absolutely get some weird fake out in the fall. Then maybe it comes back at the end of next year. I don't know. I'm just saying these are the ranges. And I think these are still totally legitimate top end, things to shoot for. If you want to change your lifestyle a little bit or, sell, again, never financial advice, but we hit it every single time, except not the scam top, the second top. We only hit in the first top in 2021. So I could totally see. I've shown this many times, I know, but just people tuning in. 125K is the trend of the power curve by the end of the year. 2x is 250. That's right on the 90th percentile. 3x roughly is, this is 2.8x, but let's call it 3x, 375. So I think 250 to 375, probably closer to the 250 because, we tend to make lower highs on this as this curve consolidates. That's what I'm seeing. If you guys think differently, let me know. Again, these mountains here now are days above the 90th, so I've shown this many times. Sometimes it resets, but roughly, 80 days here. And look, we were actually even coming down. So by the time we went back below these sort of upper ribbons, it was only 66 days, 2 months, plus these little periods. So 2 months, 2.5 months, and then another month to fall out. Dead cat bounce here in February. So all told, you can be 4 or 5 months, but obviously selling at 20K at the end of 2017 is much harder and much different than selling at 10K in March, February of 2018 as we're going down to 3K. I'm not a timer. I'm not a trading view guy. I just like to run the numbers on the big math to see like the big picture. I talked about this yesterday. Some people say we're just going to go on this nice gradual trend. I'm not a believer in that thesis, just simply because we have not invalidated the prior examples. But also people that say we're kind of, okay, it's ETFs and we're growing sort of normally more stable. What is the trend that you believe in? Because a lot of them don't believe in the power trend or don't understand it. So if you could say it's just going to hug the power trend, maybe. But we tend to, as they say, go exponential. Where's our buddy Sminston's crab walk? It's very good. This is from June. Let me search this page really quick. Oh, he did one from August. Good. So this is a good indicator. Let me get this. Does he have prior cycles here? No, but he does have standard deviation. So again, just analyzing, like if you picked, say, the bottom of the cycle to the top, then you would get an exponential curve. But you have to just only pick those short periods. So he did it here. Straight line on log scale, log linear is exponential. And what he is showing by May of next year, $200K, to get to $200K by, say, the end of the year, roughly you're in the 1 sigma up or 2 sigma up zone. Yeah. So that's even more conservative, frankly, than what I'm saying. But it makes sense, right? I mean, still in the power curve. 1 sigma is roughly 2 sigma should be something like the 90, even the 97th and a half percentile, because then you'd have the 2.5 percentile on the bottom. So 2 sigma is still, this number 200K by roughly the end of the year is still the 97th and a half percentile, roughly. Now my percentiles are going to be different because it's over the power curve, but still the 97th and a half percentile on the power curve, which is possible, is 350. So as a percentage on the power curve, I think it's totally possible, again, that we hit the 96th, 97th percentile. If you could follow my logic there. Hi, Dominic. Good to see you. Yeah, I was thinking so too. I hadn't really paid attention, but David actually threw cold water on it. That we might not have the rate cut because of the inflation worries. But this is why I make these charts, right? Again, this is only from March. The inflation, of course, is real. Increase in the money supply is real. Regardless of whether it shows up in the numbers or Trump fires a BLS worker or the Fed does or doesn't cut, it doesn't change my thesis over the long term. And I do not see them even remotely getting close to a situation like this where they have to let the money supply collapse for, a year and a half, or actually 2 years. So, end of the day, the thesis remains. I think I saw it might have been from Fred or might have been from Plan C, can't remember, but we're still theoretically right at fair value, guys. Again, if you assume the power curve is fair value, if you assume we're in, coming up from a really deep bear in 2022, Peter Zion saying it was $1,000 overvalued, zero, $17,000 overvalued when it was 16,000 on Joe Rogan. Again, not financial advice, but it's quite a bit lower than where the prior tops have gone. And if we assume this is fair value, any point on this curve is fair value, then we look good. And like I said yesterday, I am quite content, just in general, to think about where Bitcoin could go every time it's above this black line. Because every time it's above this black line, you stamp on a new level of bullish sentiment in the model. You pull every line up at the end of the day. And I haven't gotten it together. I know I talked about this yesterday, but I will. I think it would be cool to show you. I got to think about how I can calculate this because it's so annoying to do this over in this way. But if you imagine, so if you look at this roughly 2030, which is end of the decade, or end of the decade plus 1 year if you assume December 2029 is the end of the decade. You take 558,000. That's what the curve shows right now. But when we would have the curve measured, say, back here, that 558,000 would be higher. It'd be closer to 600, if not more, right? Because it's being pulled up. But then as we went through this bear, this 558,000, which used to be 600,000, gets pulled down to where it is. So it's like truly annoying to do a calculation every day. Maybe I can do this every month, but at least with my skills. But showing how that, how like sort of a goal evolves based on the price action would be pretty cool. Good morning, Satoto. Thank you for reposting. It's getting close to what I had today, guys, to be honest. But if you want to see something else, let me know. Again, you take away everything the Federal Reserve does in flows, Bitcoin is still pretty small. It maxed out at 18 trillion a year, and now it's down to a rolling rate of 7.4 trillion. So got a while to go to catch what the Federal Reserve does on a trailing 12-month basis. It's also a good example of why small countries like El Salvador can do what they do, because the need for their core flows through the system is much less than what the dollar does, or dare I even say what Argentina does. What's Argentina's system? Are they on here? MEP. Medio electrónico de pagos. Electronic means of payment. So again, if you're BOJ net, this will be good to get on there. I'll start with the big four currencies just to see how big they are, but FedWire. These are the only systems at the end of the day that are comparable with Bitcoin UTXOs. And FedWire is here. It's enormous. If we have another financial crisis, and again, I think the anatomy of the money supply is way different now because of all these bank reserves than it was here, right? When we only had 100 billion in bank reserves. The anatomy is different, but also their experience, like Fred said, they're very learned in kicking the can down the road. They will do everything that they can. If somehow the system sort of has a hiccup again, or we have another repo, a spike in the repo rate, which means basically banks are not happy with the amount of reserves they have. They want even more. Or the amount of repurchase agreements that they have, non-banks, not that they have, then they're just going to continue to do everything they can to provide liquidity, provide guarantees, maybe increase the interest rate that they receive on those reserves. We've unfortunately gone to a very socialist type system where they bail out the people that make the biggest mistakes. But as always, we have Bitcoin to as the escape hatch. But just to sort of, wrap this up, and I will wrap it up pretty soon. If you look at the money supply in total, without Eurodollars, of course, it's this red hot money, this institutional money, which is M3 money, which is the ones that have been the most finicky in the last 20 years, right? Yes, specifically demand deposits, but also savings deposits got a huge flux of cash from those, bailout checks, stimulus checks, whatever you want to call them. But this is the money that moves the fastest and is actually the least regulated. So I tend to think that look, if there's a crisis, then the Federal Reserve will just step in again, increase this facility. Okay, because you see this facility was, just to remind from the top of the show, is $2.5 trillion here. And that kept number 7 from rising too fast. So they'll just do the same thing. If for whatever reason there's a liquidity crunch or crisis or whatever happens, they will step back in, increase this facility, this reverse repo facility. It's called, by the way, it's called the reverse repo facility because that's the perspective of hedge funds. When you hold an asset of something, it's a reverse repo, and you're repoing and you're trading the treasury security like cash. If you're levering up the treasury security, it's a repo. So it is the liabilities, the repos, that are always part of the money supply that the public faces. That's everything from number 1 to number 7 is a public-facing financial system liability. And 0 is just cash that's from the central bank. So what they will do is, if there's a crisis, they'll just increase this facility, try to tamp down an explosion of this money supply, but also keep the value sort of stable so you don't have this, where this thing really falls. And just keep going. Thank you, David. Thank you for the good comments. Greetings from the Baltics. Spain is awesome. Haven't been there in a couple of years, but definitely jealous. That's where you're based. And thank you, Felix, also from Spain. So anyway, don't get too caught up in the newsletter hype. People telling you that the system's going to collapse or whatever. Yeah, they're not doing themselves any favors of keeping the money supply low, but we know that for sure they can't let it just completely collapse. They're going to have to print more if something happens. That's always good for Bitcoin. And by the way, still, the dollar dominance over Bitcoin is huge. Okay. Bitcoin's doing great, really catching up, but it's still 157 times smaller. Or stated more appropriate, the Fedwire system itself is 157 times larger as far as value of what Bitcoin does. So we got plenty of time. All right. Having said that, thank you for watching. Have a great weekend, everybody. Take care.